welcome to a very special edition of the Risk Reversal Podcast. I have Danny Moses here. He is the host of the On the Tape podcast, and we have a very special guest, someone who actually joins us maybe on a quarterly basis or so. That would be the chairman and CEO of CME Group, Terry Duffy. Welcome back to the podcast.
Thank you very much, gentlemen. Appreciate it. Great to be here.
You made this possible for us. You are our very first sponsor going back to, I want to say, late 2020. Did you think, Terry, this was all going to happen this way, man? Like, you were going to be subjected to being with these knuckleheads on podcasts every quarter?
Well, I don't know. I was going to ask you that question. How did you feel about it? I think for us, it was a natural. When you look at yourself, our dear friend Guy Adami and Danny Moses coming together to put this together originally, it was a natural for CME to want to be a part of something like this. You guys are market people, you're market structure people, you understand all different segments of the marketplace. That's what CME represents. So for me and the company, it was a natural to want to partner with you guys.
Well, I've said this many times. It is an honor for us to be a steward of your brand. You guys believed in us. And, a lot of what you're talking about is this kind of bridge between these products and the way they've evolved, the way you've evolved with the markets, the products that you've offered to new, and we're going to talk about this, to kind of new segments of the market, and that's retail. Right now, we are at the Robinhood Summit 2025 in Las Vegas. Terry, there is no rest for the weary. You and I, we went on CNBC's Fast Money together about a couple hours ago. Then we just did this amazing panel with Q on stage here, and now we're doing a podcast. So we appreciate you doing this. Let's talk about why we are here, why you are here, because this is not something I don't think that you spend a lot of time at retail trading platform conferences. You guys have been doing minis, you've been doing event contracts, you've been doing, a lot of products that are geared towards this retail. Tell us how you think about retail and how it's evolved and why you guys are becoming such an important player.
And I look at retail maybe a little bit different than most, because I'll look at, you heard Q earlier say that Robinhood is a financial firm, but it's actually a technology firm. When I look at technology, the evolution of technology over the last several years, that just doesn't apply to the institutions. That technology revolution that's gone on applies to everybody. So the way I look at it is, if it applies to everybody, there's a whole constituency that's never been in my marketplace before. Now they're going to have the ability to come in with the ease of access, the education, and at a level which is really important, that they can participate at. A lot of times people didn't come into futures because of the size of the contracts. They were just so massively large that they couldn't participate. Now, we have such small contracts to suit this constituency, so they can then participate in the marketplace to where they want to be at, and hopefully and I think without a doubt, they want to be in control of their own destiny. Mm-hmm. That this new participant in the market, not my age or somebody around my age, people that are younger today want to be in control of that destiny of how they participate. And they're smart, they're educated, and now they have the tools. So I look at the growth of retail at CME through the evolution of technology and availability of that technology.
All right, so one of the themes here is exactly what you touched on. And so some of these new products and some of the technology that is being provided to Robinhood customers here, give us a sense of you've heard me talk about this. When I first started in the business in the late 90s, I worked for a guy who traded futures all day long. And one of the things I took away from that experience is that he would probe, he would buy levels. He was looking at technicals, but he was using stops all the time. And then when he was looking to kind of make moves, let's say to the upside or the downside, he was probing for stops. You know what I mean? And so that's still the case with this product. You can't do this really with stocks, right? You can't do it with options. Talk to us about the benefit of kind of speculating. That's one way to think about trading futures. And the other way is using it for risk management purposes for hedging.
Well, I think you're right. And I think that the risk management and the discipline around risk management is critically important. So your colleague back in the 90s using stops, which are stop losses or stop gains or stop entry points, is a very effective tool for the traders to participate. And I think these younger traders today are starting to understand that more and more. If you can limit your losses or maximize your gains, which is the objective in participating in markets, you'll do quite well. If we get into a scenario, we talked earlier on stage today, our Steve made a comment, well, I bought the market at XYZ price and it went even lower. So if I liked it there, I got to love it at the next price lower. Okay, that's probably not a good strategy. That's the hope strategy. And I like to say hope is not a strategy, right? So anyway, I think that people are using the tools that were there in the 90s that are more enhanced today than ever, Dan. And they are utilizing that and the access they have. So I love where the markets are going and the participants with the use of products and technology and functionality that was around 20 years ago that's just enhanced to today's world.
Having watched what you built on the institutional side of things and now the move into retail, the fact that we're sitting here at Robinhood and your partnership with them in futures and also the event contracts, which we're going to obviously talk about, that has enabled you from a reputational perspective to know that you know how to build these things that exist. And the thing I find most fascinating for institutional investors, this may not be as intimidating, but the way that event contracts are basically just like a Nicolas Cage movie, National Treasure, where you can kind of decipher everything. It's like, okay, will the Fed raise 25 basis points? Right. It's less intimidating than trying to trade Fed fund futures, which I know you guys do, which is great. So you're changing the language a little bit to get access. Talk about
I think you absolutely hit the nail on the head, Denny. I think that people are looking for the less friction, what I would call it. And that less friction is the price of gold going to be above 3,600 or below 3,600? Yes or no? I could trade as little as $1 or more, and I have an hour to participate in that event before it closes out, and we just determine if it was a yes or a no. It's pretty simple. But yet, when you're doing that and you're participating in these binary yes-no fully funded contracts, you are looking at other things besides that may influence your decision on the next event. So you say, well, I didn't think silver was going to make the move it did as I put this yes-no bet on gold. I didn't think some of the other metals markets were going to do X, Y, Z either. So I think there's a lot going on with these event contracts right now, and I find it purely fascinating the way they're trading.
So Danny, you're into sports. You've been known to place a bet every once in a while here. I mean, how do you think of the product? Okay, so you've obviously been around lines and doing all your parlays and all that sort of stuff. Right. I mean, when you think about it from a sport perspective, do you find that is something that is going to trounce traditional sports betting?
Knowing that CME is not in that area yet, but hopefully at some point maybe, because there's no better trustworthy partner to have. But it does create a regulatory arbitrage situation in a good way for people that want to participate in the markets and events, or whether you're going to bet on a game or not. And I have found already that these markets are creating that, and the spreads are narrowing on money lines at DraftKings and FanDuel. And FanDuel obviously is now partnering with you in various things, and I'm sure DraftKings will make their move as well, because they can't stand idly by while 50 states can be approached at the age of 18 and older, and they can't be a part of it. But I want to ask you a different question on this, which is your role. You are a pioneer, or you are the leader of commodity trading in the world. And so you coming into the space validates it for a lot of people. And your relationship with the CFTC obviously is good and so forth. How did you talk about the stages of comfort and so forth that got you to the point you're like, we can do this, and then explain why it's a swap. That's all it is, and that's what you've been doing for your whole life. And the last thing, sorry, Terry, is that the thing I really like about this product is, unlike we've talked about trading history, if you go short futures in gold or something, or go long them, they might end up on your doorstep, or you may go bankrupt. You can only lose what you put into this contract. So, sorry.
No, that's really an important point there. They're fully funded, as I mentioned earlier, and you just said it again, Danny. I think when you talk about validation of a new product, when Bitcoin first started to get, first time I heard about Bitcoin was a guy by the name of John Willen. And if you guys meet John, he was worked for Gary Cohn at Goldman Sachs back in the day. So it was around 2010 or so. He said, "What are you doing in Bitcoin?" And I said, "I don't know what the hell a Bitcoin is. So can you explain this to me?" And he explained it in a way, and I said, "Thank you very much. I still have no idea what you just talked about." And I think there was a lot of us that went down that. But come 2017, I didn't want to list cryptocurrencies at CME. And my team said, we should probably list these. I go, I don't know. 2017, I picked up the phone and I listed Bitcoin. Why did I do it then? Because I really feel no different than I do today. It was about the timing. Timing is just as important as the product itself. Because I've seen, and I'm sure you've seen this in your trading career, Danny, a lot of people make a lot of money being wrong to market, and a lot of people lose money being right to market because their timing's off.
Right.
Listing product for trade can be no different. You could list something that could fail miserably, and you go, boy, that was a really good idea. Like the people of Maine, I love Maine, might want lobster futures. And I go, well, I got to be honest with you, you might be the only ones that want them. So they're probably not going to do well. But timing is really important. So when we get to the events, I've been watching these binary type events and thinking, well, I went to the CFTC. I got a no action letter to convert these into swaps. I know a lot about the swaps market, and I felt very comfortable on the risk management of them. But I actually thought something different. It was about the timing. And you talk about the gaming. I look at my average age at CME is about 42 years of age. I guarantee you 80% or 70% of those young people probably have a sports app on their phone. And when you look at that, you say, well, wait a minute. How do I get involved in this in a binary way? And who should be my best partner? So when I met up with Flutter and Peter, I said, here's my idea. And he liked it right off the bat. He knew it was not going to go after his core business. It was a diversification play to allow contracts on gold, contracts on the S&P 500, and others to be binary and diversify his client base. And he saw that. So I think that's a really good outcome. And again, I wouldn't have gotten that meeting with Peter Jackson when I did if the timing wasn't perfect. And that's really how I look at this stuff. Timing's a big part of it. So these ideas, a lot of them can be good, a lot of them can be bad. But you have to be able to understand when you're going to launch these and make sure that you have the credibility to launch these products.
Well, it's interesting. Going back to 2017 when you listed Bitcoin, I'm sure there's no shortage of folks who appreciated that from a hedging standpoint because it was also vol dampening, if you will, right? Yeah. So all of a sudden you had the ability to kind of hedge out a product. I know that's something that...
And I had just as many people telling me that, I should go to hell and everything. Yeah. This should never happen, right? You're listing Ether... Yeah. In the internet somewhere. It's nothing there.
Yeah. One thing that was really interesting, Terry, I'd love to get your take on this. So walking around, there's hundreds and hundreds of people here at this Robinhood Summit, and there's been a talk about futures, a lot of talk about futures and a lot of interest in futures, but then also these event contracts. And you just said a binary, S&P here, S&P there, right? I've heard from a couple people that that's their North Star. They say S&P above 6,600 by this date, but they're trading futures in and around that, right, which I think is really interesting. It's an interesting sort of strategy. So Are you guys seeing this sort of, trial and error, you know what I mean, among some of the traders or some of the folks that are involved in these contracts?
Well, again, we had event contracts before, but they were a larger size and not really suited for the constituency which I'm going to offer them through the FanDuel app in my partnership with FanDuel. I think that, so the verdict is still out, but when you look at Robinhood's a partner of ours too. They're one of our larger clients on the retail side. And you look what they do on a weekend like last weekend with women's tennis and with sports. The amount that's gone through binary contracts, you can see these numbers. They're staggering how many people are participating in. I think what's really interesting is what Danny said earlier, that spreads are being tightened because of another market, which reminds me a lot of the old arbitrage days when the cash will be trading so far away from the futures, and people say, well, this is easy, I'll sell the cash and buy the futures because they're going to come together and I make money. Well, everybody else figured that out and the spreads tightened up and the markets became more efficient. Is this doing the same thing? And Danny brings up a very valid point. So I'm really fascinated to see how binary event contracts correlate to the larger market, whether it's the large size gold, large size S&P, or large size interest rate contracts. So I think it's pretty fascinating how they're going to work together.
You don't do anything without a plan, and market makers are now, we know Susquehanna, and I'm sure some other market makers not far from Whacker Driver are going to get involved and talk about the evolution of how that volume begets more volume, and that's just how these markets work, right? So you expect, I would imagine, a lot more announcements are coming.
And I'm going to incent market makers to make sure that people who are trading my binary events are not in an illiquid marketplace, because I think that would be massively detrimental to them. So I can incent market makers because they can use my futures contract, to Dan Nathan's point, to hedge off that risk on the binary contract. So I have market makers who are prepared to do that today. But what I find is interesting is the international participants in the gaming world today, international gaming community, they're calling us about how they can participate in these event contracts that CME is listing with Flutter. So I should say FanDuel, Flutter's the parent company, but they have other entities globally that now want to come participate. So we will get market makers that we never thought we were going to have before that are in the events and gaming space today. That's outside of the traditional market makers as we know them that make markets for CME in and day out.
All right, let's talk markets.
All right.
I know you love talking.
Speaking of events on the S&P, what you can say above.
Let's talk markets. You got S&P at 6,500. Yeah. Okay, a little bit above.
I'm glad that event wasn't available to say no on about 6 months ago for me. So anyway, please continue.
So we got an S&P at all-time highs.
Wrong.
Yeah. Oh, jeez. Well, it's funny. We were just on this panel, and he's like, "Well, I've been telling your partner Guy Dami, I'm a little caught." That's not my best Terry Duffy. I don't even know why I was doing it like that.
I wanted him Terry do with Dan Nathan. I would love to hear.
I mean, he just sounded really dumb. That would be it. No, he said, "I've been telling your partner Guy Dami, I've been a little cautious here." And there's, I think, 11% on the S&P up right here after 2 consecutive 25% gains. And look at what happened in the first. I don't see that as some monumental sort of situation here. You know what I mean? So I'm just curious. You made a great point about your old partner, Steve Eisman. Was he your old boss or your old partner? Every time we get this guy on a podcast or on a stage, he's like, "I don't care about the debt. I don't care about the deficit. I don't care about all that sort of thing." And I hear that a lot. So you were talking about, you think it's important.
I do. I think it's really important. And I know that people believe that what number is important, because at 20 trillion, at $17 trillion debt, people were saying the same thing as like, this is a big issue. So nothing happened except the markets went up. Then we went to $30 trillion in debt, and everybody said, this is a big issue. Markets went higher. Now we're at $37 trillion debt. I'll say it, others will say it. And the other side of the equation was, well, it has not been a big issue. Why is today the big issue day? Well, the big issue day is we have to continue to issue more debt in order to pay our bills. And the cost of financing is massively high for the United States government. It's higher than it's ever been. So there does come a time where it does become important. So at $1 trillion a year, which is bigger than a defense budget, in interest payments that the government has to pay, that's a big deal. And maybe at $20 trillion deficit, it wasn't as big of a deal, but eventually it becomes a big deal. So it's the old question of, are you right eventually, or can we go to 100 trillion of debt and say the same thing and markets can continue to go up? I look at it as markets are driven by several factors, but it has to be a big part of the everyday consumer individuals who participate. So whether you're in a teacher's pension fund and they're buying equities, whether you're in a union and they're buying equity funds and the market keeps going up because that's all they know what to do is invest in these products. What happens if the labor force starts to shrink a little bit? Technology makes the labor force start to shrink a little bit. These funds get a little smaller. Then that's a bigger deal, right? Because now the buyers are smaller and the prices are way elevated. So I think eventually, and technology will eliminate a lot of jobs. Eventually, it will replace them because that's what history tells us. Technology, forever, we've seen people say that if in fact technology does this, we're going to lose a massive workforce. And all we've done is take unemployment to record lows instead. So technology is a disruptor of employment initially. And when you have that shock with the amount of debt out there, I think it could be very disruptive to the markets. That's my analysis.
Yeah. People sometimes look at the S&P 500 in isolation, and I really think, and you know this because you trade all the products, dollar's weaker. So you got to take that part out of it. This money going into gold, crypto, there's a reason that it's happening, debasing potentially of all that happening. And I think you got to look at it all. And never has it been truer. I've been a broken record on this for the last several months. Has the stock market not been the economy? You've just described why it's not. So I think looking at the S&P is kind of a false sense, or not a fool's errand per se, but I want to go back to the bond market.
Yeah.
And I want to go back to, while you listed Bitcoin and you respected the people involved like we all do that are very smart, you had issues with certain people within the industry and or products. And I don't want to talk about Tether per se, but let's just talk about this, if you have an opinion of how stablecoin is going to save the day. And listen, we can change formulas and things and be a temporary Band-Aid. So do you see anything that can really, how we're going to get through this other than, massive economic growth, raising taxes, or a combination of both occurring here? How are we going to get out of this, Terry?
Well, the only other way is if you decide to forgive debt like you did with college loan debt at the federal level, which will destroy the world. Yeah. So that's not
Put that on the event. By the way, put that on the event contract.
Yeah, that's not going to be a popular one on one side of the trade there, so that won't work. I don't know, because unfortunately, Danny, I think in order to address problems such as this, it takes more than a nanosecond, and the patience level of the participant today is so limited. We don't have a long-term view about how we want to address certain very difficult issues, whether it's crime, whether it's monetary policy. We just want instant gratification. That's what the world wants today. And you will never fix a problem like we have globally. It's just not a U.S. problem. It's a global problem. China's struggling as much as anybody right now. It's a global problem. And that being said, you need to have a plan that is multiple years and stick to it. And we don't have governments that get elected on plans like that because nobody will vote for them. Why? Because I'm going to take away your entitlement, and because it's good for all of us. I'm not voting for you, so you're out.
Right.
So I don't think we have the patience to deal with it. So unfortunately, it will probably be a bad ending.
All right, so Terry, let's go back to this scenario. You're talking about the spending, you're talking about the debt, you're talking about the deficit spending. We have been hearing about this kind of bond bubble for a long, long time, right? And now we have, make no mistake about it, we have a stock market bubble, right? If you look at what's going on, these top 10 names, they're 35% of the S&P, they're 50% of the NASDAQ 100. They're a huge contributor to whatever earnings growth is going on in the S&P 500. I think there's like the 490 in 2025, they're growing earnings 3%. I mean, think about that, 3%, right? So let's talk about those 10 names. Let's talk about the CapEx that they're spending. Let's talk about the hope that they will basically be able to monetize that spend over a long period of time. That's the argument. People will say, well, look at Amazon. They were spending, they didn't make any money, this and whatever. But look at it now, it's a $2.5 trillion. Well, that was 25 years ago. That was more than that, right? So if you think about your focus on debt, deficit, and you think about what's going on in the 30-year, right? So we were just at 5%. It's come in 30 basis points. What is it, about 4.7 or something like that? We're going to have this rate cutting cycle, okay? What does that mean for the valuations of long duration stocks, assets, like these Mag 10 or whatever the hell they are, right? That sort of thing. Because sooner or later, doesn't this debt pile, doesn't this fear, have to weigh on the valuations of assets like that?
Well, as we talked about earlier, one would think it has to, because we're not talking about the overnight lending rate. We are talking about the long term, and that's where the debt is, especially for the high multiple stocks that you are referencing. It's 10 years out to 30, some 50 years if you go to different countries on different bonds. So that is an issue, because I don't see how you can take that back end of the market where the investors are going to allow that to come down to a certain level with the amount of debt that's out there. Because who wants to hold a 30-year note getting paid nothing with the exposures that you could potentially have? So I think that's a problem. I said this earlier. The last time the Fed cut 50 basis points, that did something to the overnight lending rate, but the 10-year actually on the yield went higher. So I'm not so enamored with what the Fed can or cannot do. People need to make sure that they understand the back end of the market. When you say they hope that it does this, we've got to remember, hope is defined as you want something to happen that's completely out of your control. So think about that. So if that's your strategy, I just gave you the definition of hope, out of your control, but you want it to happen. That's a tough way to run a business.
All right, Danny, last week, we had confirmation of a weakening labor market, right? We had PPI that came out a little softer than people expected.
Maybe.
The concern was, then we have CPI. By the time you're listening to this, you're going to know CPI. Then next week...
Can I bet on that now?
Yeah.
You can.
Yeah, you can. And then next week on Wednesday, we have this Fed meeting, all right? So if the dual mandate of the Federal Reserve is stable prices and full employment, well, employment's going one way, right? And maybe what's going on with inflation would allow the Fed to cut. That was the bull case for being able to do it. How are you weighing these two things? And how do you think the stock market is going to react? Because if we start a rate cutting cycle because of weak labor market and weakening inflation, those two things are at odds with each other.
Yeah, listen, the market's already pricing in, almost 25 basis points for sure, 3 for the year. But what does it really do? Let's talk about what that cut really does. So it lowers some, adjustable mortgages that are out there, HELOCs, some auto credit card. So it helps a little bit of the margin. But to your point, what does it really do? And I think I'm concerned, and I would ask the question, like when a horse wins the Derby, but then they find out later that it was disqualified, the ticket still pays. So these revisions that are going to go on when we see PPI and CPI. So my concern, obviously, to Dan's point, is that you cut, but inflation is still kind of hanging around, and it rears its head again. And then you're in a situation where, this is what I was about to ask you, where the professional institutional traders that are out there, the people that you've known for decades that trade positions, what out there, from Dan's question, is that you're looking at? You don't have to pinpoint a particular product, or is it in FX? Is that where it sits? Because that's normally where blow-up starts to occur. Where are you seeing kind of a lot of consternation and or risk taking? Because that will decide what we should be looking at. Because I can't predict the near-term move in that. I know the long-term how I feel about things, but is there any particular product category you're watching right now?
Danny, from our standpoint, when I talk about positions open on CME, which is about the only way and again, I don't know who they are. I have the positions, I have the money. But we're looking at very high levels, close to record levels of open positions. And that gets concentrated in the interest rates and the equity, as you would suspect. That's where the majority of it is. In a normal environment, you would see that spread out through the energy complex more. You'd see it spread out through the food and metals sector more, and you're not seeing that. You're seeing more concentration in those two asset classes. And it doesn't surprise me to see it that way, because I have seen that historically move that way. And it's no different than when crude, I said it earlier on the panel, if crude trades $120 a barrel, then look out. It's going to be really exciting from a trade perspective. And if it trades $30 a barrel, you'll see a lot of activity there too. But right now, it's not there. We are seeing equities at these amazing levels. We're seeing interest rates, which we're not quite sure what the hell is going to happen. And what does it mean to the individual if, in fact, like you said, on the fringes, it might mean a few things. But ultimately, what does it really mean? And if we don't get meaningful back-end market to rally up and the yields come down on the back end, I don't know what it really meaningful means. So I think that's why I'm seeing the hedging that I'm seeing.
One of the things I noticed, to answer your question before, that's really interesting, and I think gives people a false sense of security, is investment grade bonds, which I've been a big proponent of to buy. The credit spreads are really tight. Yeah. And credit spreads are tight, things are fine. No. They would rather own corporate credits, even single or double A, than own U.S. government treasuries.
Think about that.
I feel like that's a false signal that's been going out of the market. You agree with that?
I totally agree with that. And I get very concerned about that. If the corporates, I said earlier today, there's a reason why central banks are acquiring gold since 2011, and they're concerned about other countries' fiat currency. So now all of a sudden we're going to think that corporates are safer than government bonds. I mean, it's perverse as that sounds. It might be true. Right. That's what's going on, right? So it's telling you that we like Oracle because of what happened today versus the United States government. Okay, now what does that mean for this $27 trillion treasury market if that's what we think?
Right.
That's a little frightening to think about.
It's interesting. It just seems like there's a fragmentation in a lot of market participants right now. Like to your point about an Oracle, that it could gain $250 billion in market cap in one day for something. Like, here's the thing. I actually had an analyst today on Fast Money who said, because I gave my whole take on what's going on.
Don't tell me which one was it. I'm not going to be upset.
Yeah. Okay. So
we'll get the tape.
So we're talking about Oracle, and I said, wait a minute. So this company just gained $250 billion because they have a backlog that, like, they're literally guiding to 2027. Like, that's what the guidance is. And we're just supposed to believe that? Like, what a load of shit, right? So, they know what they're doing here. They see everything else going around. They see the hundreds of billions of dollars that their peers who have real market share in this, data center space, and that, Oracle has like 4% of the market share, right? So how are they going to take share? They're going to do it on price, right? So it's going to hit their margins. They don't have the balance sheet or the moats, right, to spend the way Facebook and Amazon and Google and Microsoft are, right? Or OpenAI, that sort of thing. So I think there's a bit of a shell game, and something really interesting happened today. So this stock closes up 37%, Oracle. Okay, it's the number one now position in the IGV, which is the ETF that tracks the software space. Then it's Microsoft and Palantir. They're 30% of that. Okay, so that was up because of them. All those enterprise software stocks in there trade like dog shit. Okay, but the NASDAQ 100 closed unchanged today, with Oracle up 37%. That's kind of goofy town, isn't it? A little bit.
It seems like it's a little goofy town, but let's go back to our earlier conversation. And I'm not saying this is how we should base our lives on, but prediction markets. There is a prediction market right now that's offered by our host that says who will be the dominant AI by year end. And right now, it was ChatGPT, which flipped to Gemini. And even after the Oracle announcement, they didn't crack the top 4. So if we're going to go back to our prediction comments, people don't believe what you just said, that the 2027 story about how great we're going to be come 2027, because these other market participants go, no, I still think Gemini and Google will be the dominant AI company by year end.
Yeah. And I said this on the show. I'm like, if you are buying this stock up 37%, then you're just doing it wrong. Based on that guidance, are you kidding me, for 2 years out? So Danny, when you see this sort of rotation that we've had among, Microsoft's down 10% from its earnings date when it reported, a huge beat and raise, stock closed up, huge gap. What was it, 8% or something? Closed at the lows. Now it's down 10% from there or whatever. It just seems there's a rotation under the hood. We saw Google gap up after that DOJ decision that we're going to break them up, that sort of thing. So what does that rotation in the NASDAQ 100 or the top 10 names mean to you?
It continues to be a secular trade, not a cyclical trade. And they can say what they want because these other companies have come through with some of what they said. We were talking a year ago. I can't believe it's gone on this long, that the order rates, the fill rates, I would say, are still happening. Now, whether those are self-funded by NVIDIA and these other companies and loans are happening and what's occurring, but it's a secular trade. And so until that ends, and at some point, it will comp.
Well,
at some point, 80%
cyclical, though.
Well, no, cyclical would be
slows a little bit.
It's not even, but this is trading completely away from the economy. And to Terry's point, it actually can have a negative impact on the economy in the long run. Raise higher power prices. We're nowhere near the uranium that we need. Nuclear demand. It's going to happen.
Yeah.
So I think the impact. I think the better way to say, okay, people are focusing on those names to express. They know they're going to be okay on earnings for now. They know they got the Momo, behind them. But at the end of the day, it will become cyclical at some point. So that's to me the stuff that I look at. The ancillary plays with buying uranium or things like that I find are interesting without taking the big risk. But you're right, 250 billion market cap. Could it have been underwritten that poorly? I don't think so. If I'm a salesperson at Oracle, I'm feeling pressure, right?
Yeah.
I have to give what I think. Hey, Danny, what you got the West region? How we look? I'm like, pretty good. I think just throw 10 billion in there. I'm talking to people. I might get it.
Your finger.
I don't know, Vegas. I shouldn't do anything like that.
Don't shake Danny's hand.
Anyway,
out of here, Terry.
That's all I got on that.
But I do think when you look at some of the moves in the marketplace, because of the way people are managing certain amounts of large pools of dollars, and we talked about it earlier, they are invested in 7 or 8 names. You're going to naturally have large percentage gains and losses on any news whatsoever automatically, because there's no one to take the opposite side of that trade. And that's a concern up and down. So when you have a move where people want to participate in Oracle, they all chase the same trade, and there's no one's jumping in front of the freight train. So we're going to have a 30% move. And I'm not a bit surprised by it, to be honest with you, because of the way the markets are trading, because I know how markets are, and I know I don't jump in front of freight trains, never have. But at the same time, historically, you had people on both sides of the market. We don't have that right now.
I want to get a prediction market on Oracle filling in in that in the next year. I'll bet you my right.
Pinky, you're in Vegas, by the way. They will take it from you.
Tip of my right.
I'm keeping my pinky, so I'm not betting you.
By the way,
I used to say I'll give you my cat if.
That should be an easy
my
one.
wife's cat.
Anyway, I would say one thing to Terry's point. I know we got to wrap here. Is that it's market structure. So the point that Terry just made, there's more ETFs than there are stocks at this point. Supply and demand, and the quant models know that.
Right.
So when a stock starts to go up 5-7%, it becomes self-fulfilling 2x Oracle ETF or whatever. And it just is. And so when the reverse happens, it'll be an elephant through a mouse hole.
All right. So Terry,
absolutely.
We were just talking about cloud. A few years ago, you did this deal with Google Cloud. It's not only that you did this deal, this was a major technological transformation for your exchange.
Mm-hmm.
They also, Google invested $1 billion in CME. I think that's been a good return for them at this time. What did you see now that you see everybody scurrying around for, like cloud, compute, that sort of thing? You were kind of ahead of the curve for a big business like this.
Well, we were, and what I saw was the efficiencies in what Google can do or one of the other ones. And to have a partner, to me, was more important than have a service provider. Anytime you can get a partner versus I could go to 5 different cloud providers and probably get a better deal than dealing with one. But when you have an invested partner in making sure that their investment is important, not just from a dollars and cents, but from a credibility standpoint. I knew that if they can't deliver, that's a problem for Google, right? They've been delivering for CME. We're delivering for them. That it's like liquidity. Liquidity begets liquidity. And I truly believe that when you look at the growth of Google Cloud in the financial services, that's not an accident. When I went and did the deal with Google Cloud, I think they had 6% of the Google Cloud market. It was small. People said, why aren't you going to Amazon? Why aren't you going with Microsoft? I said, because I want to be part of the growth with them in the financial services. And I think it's worked out well for both of us.
All right. Well, if you can hear that behind us, that was for Vlad. He's the CEO.
That was for Dan Nathan, ladies and gentlemen.
By the way,
Danny Moses and Dan Nathan.
We actually were right on before that. You got a big applause there.
That's good. I was begging for it, and you got it. Thank you.
There you go. Listen, Terry Duffy, we really appreciate just your support. We appreciate you coming on here. We appreciate your insights, and we're really rooting for you. You are democratizing your product for an audience, for a customer base that actually hasn't had access to it. You've done some amazing partnerships with companies like Robinhood. I know Danny's all geeked up about event contracts. You're going to be expanding those, we hope, into some things that he really cares about.
I think so.
Yeah. So Terry Duffy, we really appreciate you being here.
Dan Nathan, Danny Moses, you guys are unbelievable guys. I appreciate everything you do. As I said at the outset, it's easy to partner with guys who understand markets. They understand when they're wrong, they get out. When they're right, they write it out. And they continue to evolve. And I've seen that through both of you, through your careers. And so I'm honored to partner with you. So thank you
so much. Guy Dami thanks you. Wherever he is.
We're not going to thank him. You're not here. No thank you.
But by the way, Guy Dami, we've done hundreds and hundreds of podcasts over the last 5 years. The next one he listens to will be the first one. So
right?
We're okay. We can say whatever we want about it.
You know what they say, if you're not at dinner, you're on the menu, right? So we're going to skew Guy Dami.
Again, Vegas, another dangerous Vegas comment.
I love it. All right, Terry Duffy, thanks so much for being here.
Thank you, gentlemen. Appreciate it.